Okay, picture this. It's Union Budget Day. The stock market is just a sea of flashing red and green. Tickers are racing. It looks like total chaos, right? But what if I told you there's a hidden logic to all of that madness? Today, we're going to decode exactly what savvy investors are looking for in the budget so you can see the pattern behind the panic. Let's jump right in.
So that really is the big question, isn't it? When you see all that crazy volatility, stocks shooting up one minute and then crashing the next, is it just random noise? Or is there actually a predictable pattern that smart investors are tracking, with total calm? Well, the reality is way more calculated than you might think.
You should think of the budget kind of like an iceberg. The headline news you always hear, like, oh, they've changed the income tax slabs. That's just the tip. What really moves the market is the massive, hidden part underneath. All those subtle signals that tell you exactly where the entire economy is headed for the next year.
And that huge structure, it really just boils down to these three crucial questions. First, are people like you and me going to have more money to spend? Second, where is the government itself planning on spending its own money? And third, which specific industries is the government going to give a little extra push? Let's break each one down. All right, first up is what we call the consumer demand signal. This is all about tracking how changes in your personal finances can send these powerful ripples all through the economy, and that creates some really interesting opportunities in the market. This slide lays out the chain reaction perfectly. So when the government cuts taxes, people suddenly have more money left over after they've paid for all the essentials. That's your disposable income. And what do we do when we have extra cash? We spend it, right? Usually on stuff we want, not just stuff we need. And that is a direct shot in the arm for companies in the consumption game. And who are these companies? Well, think about it. Auto companies, see more car sales, jewelry businesses, makers of consumer durables, that new TV or fridge you've been looking at. They get a big lift. And of course, retail stocks in general just do great when people are out shopping. It's a simple equation. More money in our pockets means more sales for these guys. It's that direct.
All right, so that's what happens when we get more money. Let's move to our second signal, which is all about what happens when the government itself starts spending big. This is driven by these huge investment plans, and a powerful term you'll hear all the time is Capex. So what exactly is Capex? It just stands for Capital Expenditure. Now, this isn't money for the government's day-to-day bills. No, this is the big stuff, the money spent on building long-term assets for the whole country. We're talking about the kind of projects that will fuel economic growth for years, maybe even decades. The logic here is super straightforward. When the government announces a higher Capex budget, it's basically shouting from the rooftops that a ton of massive projects are about to get the green light. For the companies that actually build these things, this means more predictable revenue, what the market likes to call a strong order book. And this slide gives you a perfect snapshot of where all that money goes. We're talking about the fundamental building blocks of an economy. Building new roads and highways, modernizing railways, putting up city metros, developing ports, and funding these enormous power projects. Companies in these spaces are the direct winners when the Capex budget is high. Now for our third and final signal, sector priority. This is where the government decides to, put its thumb on the scale and give a specific industry a major push by just allocating more funds directly to it. It really boils down to this. When a sector gets a bigger slice of the budget pie, it's like the government is placing a gigantic order with all the companies in that industry. For those domestic companies, that's a huge vote of confidence and, let's be honest, a guaranteed payday. A classic example of this is the defense sector. This is an industry where government spending isn't just a factor, it's pretty much the only factor that drives everything. And what's so important to understand here is that even a small, unexpected bump in the defense budget can cause an immediate and really powerful positive reaction in defense stocks. The market just sees it as a direct signal that more domestic manufacturing contracts are coming right around the corner. Another budget favorite is always the railways sector. For decades, investors have been glued to the budget, just scanning for any clues about upcoming projects and modernization plans. When the budget mentions railways, investors are listening for very specific keywords. Are they funding the expansion of tracks, pushing for full electrification? Are they ordering new, modern wagons? Or maybe upgrading the signaling systems? Each one of these points to specific companies that are going to win those contracts. And, more recently, a new hero has kind of emerged in budget announcements: green energy. As national priorities have shifted towards sustainability, this whole sector has become a major focus for government policy and support.
And any policy support for green energy doesn't just help one type of company. It benefits an entire ecosystem of businesses. This includes companies involved in solar power, the whole EV manufacturing supply chain, wind infrastructure, and that super important battery storage technology.
So we've covered the three main signals, but the sharpest investors don't just look at them one by one. They look at how they all connect, how they create this domino effect across the market. Sometimes, believe it or not, the indirect impacts are even more powerful than the direct ones.
This is such a key insight. A budget announcement for one sector can create a powerful tailwind for a completely different one. You have to learn to spot these second and even third-order effects.
This example with housing makes it totally clear. Let's say the budget announces some incentives for home loans. Okay, this directly helps real estate companies, obviously. But then what happens? More homes being built means a massive jump in demand for building materials. So all of a sudden, a company that makes cement, which wasn't even mentioned in the budget, becomes a huge indirect winner.
This slide right here really pulls it all together. You can see the direct line from a budget announcement all the way to a market reaction. Tax cuts lead to more spending, higher capex leads to more building, and targeted funding gives a big boost to specific industries. This is the playbook for understanding budget day. So, as we've seen, the market's reaction is, well, it's far from random. It might look chaotic on the surface, but underneath, it's just a series of logical conclusions based on the signals the budget sends out about where money is going to flow in the economy.
And that's really the ultimate takeaway. The noise and the crazy volatility on budget day can be really intimidating. But if you understand the underlying logic, those three key signals of consumer demand, public spending, and sector priorities, you can start to see the pattern behind the chaos. The only question is, which signal will be the strongest next time around?